Hello everyone, so today I'm in Belgrade in Serbia. I'm traveling around Europe. I was going between Budapest and Montenegro, and on the way I decided to stop in Serbia, and then it happened that Scot Osheroff, with whom I've done a few videos, is here in Serbia. So Scot is a fund manager. He's been living in Asia for over 11 years, correct?
Correct.
Cool, fantastic. So we did a few videos together on commodities, on geopolitics, etc. So Scot, what are your thoughts on the latest market developments, on generally what's happening in the world?
So firstly, it's good to see you again. I can't believe it's been a year since we caught up last time in Turkey. So in regards to the markets, you know I'm heavily invested in the commodities space. So I've been watching that space intently. And really over the past 18 months, we've had more or less a cyclical correction in an otherwise secular bull market, in my opinion, in the commodity space. You had rising rate hikes, degree of credit contraction. You're seeing M2 fall. It's sort of moving back in line with its historical uptrend, but nonetheless, you've gone from a period of outlandishly excess credits to a tighter environment globally. Central banks try and rein in inflation, which of course I don't think is going to work, but nonetheless, they're raising rates, and you're seeing the system experience strain. So with this cyclical downturn, the commodity space has been hammered, but nonetheless, it's still held up relatively well. So in the past few months, I've really been quiet, haven't been trying to watch the markets, not a whole lot, because there hasn't been a whole lot to focus on in terms of upside. It's more along the lines of staying put, since I'm happy with what I'm invested in and the underlying themes for energy, gold, silver to a degree, but the general commodity space is more or less a hold it and wait through the cycle. Since I'm not a trader, I'm a long-term investor. But what's increasingly interesting to me is that with tighter credit, with M2 falling, with the debt ceiling having sort of been raised indefinitely, if you will, and this flood of debt which is being sold, the question that I have is who's going to buy it all? And timing is a key, and it's huge, but it's difficult to get timing right. So I'm looking at a few scenarios, and one is that in the US, with all this debt being sold.
Sorry, there's a spider.
Thanks. With all this debt being sold, that you either have rates go crazy, and the 10 years already above 4%, and eventually that breaks something if no one is there to be a buyer of last resort. And then you have a severe credit contraction, and perhaps you have a nasty recession. We'll see. But otherwise, I think in due course, you probably have the Fed step in and buy this excess debt for sale in some form of yield curve control, whatever that might look like. Of course, the question is timing. Do they keep raising rates throughout the summer? Does debt continue to be sold and rates continue to tick higher, which long-term benefits the owners of debt if there is some type of yield curve control, because as rates go up, the U.S. government continues to pay a huge amount of interest. But I don't know the timing for that. Alternatively, I guess similarly, you look at Japan, and Japan's facing sort of the end of, they're coming out of the cycle that I think the U.S. is going into. For 2 decades, more or less, they've had some form of yield curve control. Inflation's running hot in Japan, and they're not raising rates. And the question is, do you destroy the bond market and the economy as a result, or do you destroy your currency? Japan, I think, is going to be a fascinating litmus test over the next few months or whatnot to see what potentially happens in these Western economies in the future. So that's sort of how I'm looking at the market. But nonetheless, in the U.S., for example, as I mentioned, sorry for being long-winded, but you either have bond yields go crazy as there's a sell-off in the face of new issuance, and that leads to a credit contraction, some type of credit crisis, recession, sort of like the banking crisis we saw a few months ago, but perhaps worse. Or you see in due course yield curve control. Medium term, in the commodity space, either I think is wildly bullish. Not to say that it won't be painful, even though to a degree it already has been painful with some corrections in uranium, oil and gas, etc., coal. But if there is that credit contraction, that just means that there's going to be even less investment in the space over the coming few years. And we already have structural deficits in a whole host of commodities. Banks that won't finance coal mines, et cetera, or you then have some form of yield curve control in the intermediate term where the dollar gets sacrificed. And if the dollar gets sacrificed, commodities rip. So I'm bullish regardless, but again, it comes down to timing. So that's how I'm looking at the world today. And it's certainly one of uncertainty as we wait to see, does the Fed raise rates next month? And I guess it's July already. But it's one of wait and see.
So when you're playing the commodity space, because you say either way it's bullish for commodities, it's just a question of timing. What if there is massive credit contraction? Doesn't this impact your portfolio in terms of the stocks that you own in mining, for example? So not owning explorers that need financing within the next year or et cetera. How is this impacting your portfolio construction?
Yeah, 100%. Because as we know, when it's risk off, miners that are in the early stage of exploration or whatnot can move towards zero very quickly. Liquidity crises are interesting, but for my portfolio, really, and when it comes to miners, I have a few precious metals miners, but most of my miners, if you will, are in the uranium space. And probably 70% of my book is on companies that have, or allocated to companies that have production or have assets that historically produced. So I have small tail of companies that are on the exploration space, more so in North America. But yeah, it comes down to being risk adjusted and knowing what you own and being comfortable with it. So, but I also am okay with volatility, which a lot of people aren't. But volatility is where you make money. Volatility and patience and being able to take advantage of it is the key.
And I think this is a skill that people will need to develop over the coming years, potentially decades, is being able to stomach more volatility than we've been used to in the past as investors.
Yeah, 100%. I think the days of buying something and holding it for 10 years are completely done. We've talked about this a lot, and maybe I'm biased because I've lived abroad for 11 years. I've seen, various frontier and emerging markets, middle classes grow and whatnot. But I also question at one point you're going to see them sort of get stumped, and you're seeing it in Europe as well. Well, I guess if you look at long-term credit growth, we're at the end of a debt cycle, and therefore you're seeing more inflation as governments try to inflate their debts away. But that ultimately destroys the middle class. So buying consumer goods companies, discretionary companies, they're all going to get impacted by rising commodity prices. So I think it's difficult to just park your money and say, well, there's a recession every 5 to 7 years, and it's shallow, and buy the dip. I think you need to be much more tactical these days.
Yeah. I'm very wary of just buying indexes and just buying and forgetting about them. Like you say, it worked in the past, but it doesn't mean it's going to work in the future. I prefer to be more active in terms of my portfolio management nowadays. I would rather not be more active. It's way easier to just buy an index and forget about it and live life. But unfortunately, in the world that we seem to be entering or have already entered, I don't think this will be a winning strategy anymore to just buy index and then just sit back.
Agree with you, and I think part of the reason is because over the past 30 plus years, indexing has become so popular with ETFs and all of this and whatnot, that which becomes easy is that which you should not do. So 20 years ago you could do it, but now everyone from a 15-year-old with a joint account with their parents to an 85-year-old is in ETFs, because most wealth managers and whatnot, they're not stock pickers. They're not doing DD on all these companies. It's much easier to buy an ETF for oil and gas. It's an ETF for uranium or the SPUs or the Qs. Yeah, you definitely need to be much more tactical. And on that note, if I may, with what I mentioned before was sort of my macro framework, I think that with whatever happens, in whichever sort of scenario we go down, if either of the two, there's always a potential for something else to happen. But I think that you're definitely going to see over the next, say, 6 to 12 months, this rotation back into value, which we lost track of, if you will, in the markets over the past 6 to 12 months as everyone went for tech. AI's gone crazy, and in my view, I think this is a bear market rally, and you're seeing managers chase these tech companies. Right? I think it's 7 companies that are generating the most of the return. But if you're a fund manager and you have to report to your investors either monthly or certainly quarterly, you need to be in that which is going up. To be in uranium, coal, copper, things that really haven't done much over the past few months, it's difficult depending on your investor base. So I think that when you do have this correction is, again, credit tightness bites from PE all the way to the public markets, is you've got a huge amount of margin in the market. You'll see this rotation out of high beta tech into value again, which is, again, as we've discussed, not to try and sound like a broken record, but it's what at least I think is going to be the play for the next decade, if you will, is value.
Thank you, Scott. Look, everyone these days is talking about the US, Europe, Russia, China, India, the Gulf, with everything that's happening there. Increasingly Latin America as well. But a part of the world that nobody discusses, apart from Africa, is Central Asia. So you live there most of the year. So what's happening there? Because if we're just sitting in Europe or the US, we never hear about Kazakhstan, Uzbekistan, Kyrgyzstan, Turkmenistan. Like what's happening in that part of the world these days?
A lot. But as you said, it's not widely covered. I have a friend that lives in Almaty, which is the former capital of Kazakhstan, and he likes to say that Almaty is the most beautiful city at the end of the world. It is Central Asia. It's difficult to get to. But these countries are really commodity countries. They've got great demographics, young populations that are growing fast. Again, they're backstopped by commodities. Uzbekistan gold, Kazakhstan a bit of gold, but hydrocarbons. And these countries, of course, are integrated with the global economy, but not to the degree that countries like Vietnam, Bangladesh, India are. So they're much less correlated with the rest of the world. And therefore, for example, during COVID, Uzbekistan still grew 0.3%. I think it's really the place to be over the next few years for part of one's allocation, emerging and frontier markets in general. But I look at, and we discussed this in our last video, what I call the new Fertile Crescent. You look at this part of the world, and I think it was Russia announced this past week that in August they're going to launch a BRICS-backed currency, or a BRICS currency backed by gold, at least for some type of clearing mechanism. So that'll be interesting, but this entire region is integrating, and it's part of the acceleration of the bifurcation of the world. And this part of the world doesn't need to do business with Europe. It doesn't need to do business with America. Central Asia can do business with India, Pakistan, Iran, Turkey, the greater Middle East, China, Russia, exactly. And these countries' governments play, arguably, they certainly play by different rules, but they play, I'd argue, in a more capitalist way, unlike what you're seeing in the West. So there's
very little ideology in these governments.
Money.
Yeah.
Money and continued prosperity for your population.
Yeah.
That's pretty much it. It's very easy, cut and dry. So yeah, I've been in Uzbekistan for the past 4 years, and the country's absolutely booming. But the question, of course, is how to play it. There's the Uzbek stock market, which we're heavily involved in. But I just flew in yesterday from Kazakhstan, and the Astana International Financial Center. I was there in 2018, and it's on the former grounds of the World Expo. When I was there in May of 2018, there were 12 companies at the Astana International Financial Center. It's a bit of a challenge. Now there's at least hundreds, if not thousands. The Kazakh Stock Exchange in Almaty it still exists, but all the companies more or less have relisted to Astana. And I think that with what's going on in Russia, there's an opportunity for Astana not only to become the financial center for Greater Central Asia, because it's connected to Euroclear, Clearstream. You have decent brokers there, and there's common law. But you're seeing companies that were doing business in Russia that were listed, say, for example, in London, and one of them is Polymetal. And Polymetal is one of the 10 biggest gold producers in the world. They have assets in Russia and Kazakhstan. They actually listed in Astana about 2 years ago. But because the Russian business is sanctioned, a lot of brokers like Interactive Brokers won't allow you to trade their stock. So the stock's collapsed. And for reference, production-wise, they produce about 33% of what Newmont Mining produces, but they trade at 3% of the market capitalization.
Wow.
So huge dislocation. And what they've done is on the 17th of July, they're delisting from the LSE. They're going to move their primary listing over to Astana, keep their existing corporate structure though, and in due course, well, they've already ring-fenced the Russian assets, and in due course, I believe the plan is to split the company in two, Russia, Kazakhstan, take the Kazakh assets, keep them listed in Astana, but also dual list them in, say, London or the Emirates, and then we'll see what happens with the Russian assets. But nonetheless, there's huge optionality. And what we were talking about before, when eventually push comes to shove in the bond market and with this current credit cycle, where eventually I foresee more money printing and stimulus, gold, that's probably gold's time to shine. Gold and silver has struggled since, I think, the end of 2021. They've been in consolidation, but I'm increasingly getting intrigued by gold and silver again because everyone's left them for dead. While a lot of people are going after oil, gas, uranium, no one's really talking about gold and silver. So when that happens, I look at a company like Polymetal that's super cheap for a reason, but their all-in sustaining costs are about $1,300 per ounce, and as gold goes higher, when you eventually have that re-rating, I think that re-rating is going to be vicious. It might take 5 years, it might take 10 years, we'll see, but it's an interesting option in the precious metal space, and it is a result of sort of my due diligence into the company and being in Kazakhstan this past week. I definitely see Astana as being a magnet for other companies that do business in Russia or the general region that are looking for liquidity and a first-class jurisdiction for the region.
Why wouldn't they go to Hong Kong?
Costs. I think in due course they will. I mean, you have a couple of Russian companies that are listed there, but the question, I guess, is Hong Kong has a certain investor base that is not very global. It's more regional. And Hong Kong's experienced a whole host of issues from companies leaving, expats leaving. It's still a financial center for China to be able to access dollars, but arguably I think the Emirates would probably be better because you think, who understands Central Asia really well? The Chinese understand it to a degree, but the Middle East is, if you ask a Russian, if you ask anyone from the FSU, you've just made $5 million, you can go live anywhere, but nowhere that you really need to go through the struggles of getting a Schengen visa or buying a passport or whatnot. The first place they're going to probably go buy a property and get residency, correct me if I'm wrong, Dubai.
Yeah.
And the amount of money that has moved there since the war started is significant. But even before that, and you've got an IPO boom in the Emirates. Abu Dhabi is on fire, so it seems like a natural jurisdiction for these companies to at least dual list. And of course, you have a huge amount of Middle Eastern capital flooding into Central Asia because, again, Central Asia is an Islamic region.
Fascinating. Cool. So Scot also runs a very interesting Telegram channel called Yorta. There's a link below. I really encourage people to subscribe to it. It's completely free. And essentially, as he travels around the world with a big focus on Asia, he shares some of his thoughts on what he sees on the ground and talks quite a bit about the commodities space as well. Great. So Scot, thank you very much for your time today.
Great to see you. Take care.
You can go to my website, thewanderinginvestor.com, and sign up to the private list. It's entirely free. This way you will be getting insider information as I travel around the world looking for opportunities. Lastly, feel free to follow me on Instagram at The Wandering Investor. I look forward to hearing from you.